Investing is something I'm very passionate about because in my 24 years as an investor, I've seen too many people with too many regrets, mainly financial. The intention with this channel, with this live stream, is to help as many people as possible with my experience to invest into assets, build wealth, and potentially retire early. So today I'm going to give you a little cheat sheet so you can invest in the stock market with low cost index funds confidently. But first, I'm going to nudge you towards two of my latest playlists to help you even more, and my free investing community on school. So my two latest playlists. One is how to retire early. Basically, it's 5-10 minute videos covering mindset, personal finance, financial literacy, mistakes to avoid, and how to retire early with index funds. Basically, loads of information on mindset, on investing, why investing is so important, on compound interest, loads of examples of compound interest, mistakes that I've made over the last 24 years, and finally, how to retire early step by step with index funds. My latest playlist is how to invest with index funds step by step. Basically, it's a free course. Again, 5-10 minute-ish videos that's going to help you invest in the stock market step by step, literally step by step. All I would say with both playlists, with all of the videos, take some notes so you actually learn the information. It's important. It's important. Investing into assets is massively important when you look into it, when you understand things like compound interest and inflation. Hopefully you will after this little live stream. So, my free investing community on school. The link can be found in the description on all of my videos and on my actual channel. There you're getting free content, free courses for you to complete. And if you've got any questions relating to the content, to the course material, just ask me in the group. You're getting around hundreds of other like-minded investors for help and support. You're getting one-to-one support from me with my 24 years investing experience. Now, I'm not an expert, not even close. I'm not trying to say that, but I have got loads of experience. I can help you, and I genuinely care about you, your investments, and your future, so you can secure your future. Anyway, moving on to the beginner's guide to index investing, a step-by-step cheat sheet. Now, if you want this cheat sheet as a PDF copy, PDF document, type yes below and I'll send you it. Something for you to refer back to help you invest literally step by step. What is index investing? Index investing is a passive investment strategy where you invest in funds that track a stock market index, like the S&P 500 in the US or the FTSE 100 in the UK or MSCI World global markets. Instead of picking individual stocks, your money is spread across hundreds or even thousands of companies all at once. Key benefits of index investing. The main one for me personally is it's stress-free. That's why it's my favorite way to invest. Diversification. Reduces risk by spreading investments across multiple companies. Low costs, much cheaper than actively managed funds. Simplicity, no need for stock picking or constant monitoring. Again, stress-free. Historical consistency. Stock market indices have averaged 8 to 10% annual returns over the long term. Passive investing. Set it and forget it. Your money works for you. You're not working for your money. How to get started with index investing. 1. So this is going to be divided into sections. Number 1, understand your relationship with money. Before you start investing, check your emotions about money. It's important, trust me. Many people fear losing money, chase get-rich-quick schemes, or make emotional decisions. This can lead to panic selling during market drops, buying high and selling low due to fear or greed. Please avoid this. Trying to time the market, which often results in losses. Now, a lot of people, a lot of investors, traders, try to time the market. No one can, in my humble opinion, from my experience, the books I've read, the YouTube videos I've watched, no one can time the market. It's not about timing the market, it's time in the market, as the saying goes. Trying to time the market will result in losses. Solution. Recognize your emotions about money and develop a neutral mindset. If you can be neutral and calm around money, it makes you a better investor. Simple as that. Treat investing as a long-term journey, not a quick win. Follow the proven strategies of successful investors like Warren Buffett, John Bogle, Ray Dalio, etc., etc. 2, learn about compound interest, your wealth multiplier. Compound interest is basically interest on top of interest. This means the longer you invest, the more your money grows exponentially. If you fully understand compound interest, you will invest into assets. It's as simple as that. Compound interest is what builds wealth. Example of compound interest in action. Invest in £100 a month at 10% return grows to 632,000 in 40 years. Invest in £500 a month at 10% returns grows to 3.1 million in 40 years. Invest in £1,000 a month at 10% returns for 30 years result in 2.26 million. Yes, 30 years, 40 years sounds long, and most people haven't got the discipline to do it. They haven't got the mindset. But you can get early retirement investing for shorter periods, depending on how much you invest, what you invest into. You can invest in, I believe, honestly, if you focus on financial education, you invest into assets, you invest for like 20 years, 25 years, you can get early retirement. Key lesson, start as early as possible to maximize the benefits of compound interest. Even small monthly investments grow massively over the decades. 3, build a cash buffer before investing. This brings calmness from my experience. It's important. Notice how I keep saying important. Investing is important. Let's just leave it there. Before investing in the stock market, you should first secure an emergency fund. This prevents you from having to sell your investments in a financial emergency. Recommended cash buffer when you look into it, when you read the books. 3 to 6 months of living expenses in a high interest savings account. Again, from experience, once you get 3, 4, 5 months expenses as a cash buffer, it does bring calmness and it will make you a better investor. Avoid investing money you need in the next 5 years. Why is this important? If you lose your job or have unexpected expenses, you won't need to sell your investment at a bad time. A cash buffer equals financial security, which many of us crave, and allows you to invest stress-free. 4, decide how much you can invest. Ask yourself, how much can I invest each month? How long am I willing to keep my money invested for? Am I comfortable with market ups and downs? Most people can't handle the volatility, but when you look into it, when it goes up, all good. When it goes down, again, all good, because you go into the sales. Most people like shopping in the sales, January sales, in back end of December, but they don't like investing. They don't like it when the investments go down. They don't like investing into sales. Hopefully you get what I'm trying to say. Suggested investing strategy. Start with whatever you can afford. Even £50 to £100 per month will make a huge difference in time. Increase your investments as your income grows. Again, as over time. The key is consistency. Investing monthly is better than making one big investment. 5, choose a low-cost investment platform, a brokerage account. You need a brokerage account to invest in index funds, popular investment platforms. UK, Vanguard, Hargreaves and Lansdown, AJ Bell, Interactive Investor, etc., etc. USA, here are some examples: Fidelity, Vanguard, Charles Schwab, M1 Finance. Europe, you've got DeGiro, eToro, Trading 212, and many more, I would imagine. Things to consider when choosing a platform. Low fees, avoid platforms that charge high management fees. This is important. It's one of the things we can control as investors. Low fees, low costs. So you can reduce your fees by choosing a certain platform and choosing a certain index fund. Certain index funds charge higher, like 0.1%, 0.1.5%. Some funds charge like 0.07%. These are numbers that I've just plucked out of thin air, but again, you get the point. Keep costs low. User-friendly interface, easy to buy and track your investments. Good customer service and reputation, and this is one of the reasons why I use Hargreaves and Lansdown. Good customer service. 6, pick your index fund. What is an index fund? I mentioned this at the start, but I'll go over it again. An index fund tracks a stock market index, like the SP 500, FTSE 100 or MSCI World. It gives you exposure to multiple stocks in one investment. It's like you're getting a small slice of several companies in one fund, like the SP 500, for example. Instead of investing in one stock, In one fund, you're getting 500 companies in the US, 500 of the top companies in the US. Choosing risk level, low risk. This is important. With investing, your risk tolerance and your financial goals are two of the most important things before you even start. So what I'm going to give you is a low risk option, a medium risk option, and a high risk option. Low risk, life strategy 20, 20% stocks, 80% bonds. Medium risk, life strategy 60, 60% stocks, 40% bonds. High risk, life strategy 80 or 100, 80% stocks, 100% stocks. Let me put it this way. If you were in your early 20s and you haven't got much, you could go 100% stocks. You could go high risk because you've got time on your hands, because you're likely to invest for 25, 30 years. But if you're in your late 50s and you've got a big pot, you might go 40% bonds, 60% stocks, for example, because you're trying to preserve your pot. 7, automate and invest consistently. Again, set and forget. Automate your investments. Set up a direct debit each month so you don't forget to invest. This follows a strategy called dollar cost averaging, DCA. Investing at regular intervals to smooth out market ups and downs. And again, some of this might seem a bit complicated, but if you get the PDF document by typing yes below in the comments, read it a few times, look at it when you set up your investments, and as you invest consistently, the penny will drop. The information will start to sink in. Ignore the noise. Markets go up, markets go down. Don't panic when prices fall. Stay invested for 10, 20, even 30 years. That's how the rich build wealth. Let compound interest do the magic. Do its magic. Check your investments only once or twice a year. Constant checking can lead to emotional decisions. Let your money grow without interference. If you're constantly checking your portfolio, it's going to mean emotional decision making. It's going to mean poor investment decisions, and it's not the way to go. Again, stay calm, stay neutral, and you'll be a better investor. 8, avoid common investing mistakes. Mistakes to avoid. Waiting too long to start. Time is your best friend in investing. Trying to time the market. Invest consistently instead. Not diversifying. Stick with broad index funds. Panic selling during market drops. Markets recover over time. Ignoring fees. High fees reduce your long-term profits. Golden rule, stay invested, be patient and let compound interest do its job. You will make mistakes as an investor. It's a fact. It's how you respond. If you make a mistake, learn from it quickly and move on. I've made, unfortunately, huge, painful mistakes in my 24 years as an investor, like losing our life savings in 2011, gambling in the stock market, without doing any research, without having any clue what I was doing. Don't do this. As I always say when I'm doing my social media online, education leads to financial literacy, and financial literacy, in my opinion, leads to financial freedom. Education is important. Don't be like friends and colleagues who, when I mention education, they just eye roll and completely ignore what I'm saying. Don't let this be you. How to become a millionaire with index investing. The key to becoming a millionaire is time, discipline, and consistency. Example, a 10% annual return. Now, we always use the example of 10% annual returns because this is based on historical data, over 100 years of historical data. This is what you would have got by investing into indices in the US. Monthly investment years to reach 1 million. So if you invest £500 a month and get 10% average returns, in 29 years, you would be a millionaire. You'd get 1 million. If you invest £1,000 every single month for 23 years, you would get 1 million. £1,500 every month for 19 years, you would get 1 million. The sooner you start, the faster you reach financial freedom. Next steps. Action to take today. Books to read. The Little Book of Common Sense Investing by John Bogle. Unshakable by Tony Robbins. The Intelligent Investor by Benjamin Graham. Action plan. Open a brokerage account. Pick an index fund, like a Vanguard index fund, for example, one of the life strategy ones I mentioned earlier. Set up monthly investing. Stay invested long term. Final little words of wisdom. Index investing is the easiest, lowest risk way to build wealth. Stay consistent, ignore the noise, and let compound interest to do the work. Before I go, I'm going to read you a little disclaimer to protect myself. The content in this document is for informational and educational purposes only and should not be considered financial investment or legal advice. Blah, blah, blah. As you can probably tell, I'm not a financial advisor. I'm literally just trying to help you with my experience. Now, to finish off, I'm going to try and nudge you towards my latest playlists to help you even further. One is how to retire early. One is how to invest with index funds. Both of my recent playlists are going to help you. How to retire early is 5-10 minute videos covering mindset, personal finance, financial literacy, mistakes to avoid, and how to retire early with index funds. And my latest playlist is again 5-10 minute videos giving you a step-by-step guide to invest in the stock market with low-cost index funds. And if you want even more help and support, you can join my free school community, my free investor community on School. The link can be found in the description to most of my videos and on the main channel. So have a look in the description, click the link, join my School community. That's where you're getting around other investors, hundreds of other like-minded investors. You get free content, free course material for you to complete. And if you're struggling, you can ask me any questions. You're getting one-to-one support from me and my 24 years experience. Like the fact that I do regular calls with my community to help them, to give them support, mainly with mindset. Because when you look into it, when you invest for long periods, you realize that a lot of investing is about psychology. It's hard, especially if you do it by yourself. So don't do it by yourself. Join a community like my School community. Anyway, if you've got any questions relating to what I've been talking about in this live stream, ask away in the comments. Anything. And if I can help you, I will help you. Please take on board what I'm saying. Investing is important. Investing into assets is how you secure your financial future. Because inflation is bad, the financial system is broken, but the rich understand money. They understand the financial system is broken, so they invest into assets. Imagine this. Imagine back in the 2008-2009 financial crisis, you were financially literate. I have a feeling that if you fully understood economics, a couple of years later, that would have led to Bitcoin. Imagine investing in Bitcoin in 2011, 2012. You'd be a multi-millionaire. This is what I believe can happen when you actually focus on financial education, when you become financial literate. Literally anything is possible. Anyway, that'll do. Thanks for watching.